2008 mortgage meltdown. Basically, the causes of it, the results from it, and the lessons we've learned. He tells me he's going to discuss why it happened and why its serious financial effects happened, what we learned from it, and what we can do to prevent similar things. Bill managed the mortgage department of a bank for about 10 years. So this is kind of an insider's view of what happened. So Bill, if you would go ahead and get started and give us the inside scoop on what happened.
Okay.
It's all yours, Bill.
Okay. The mortgage meltdown. The mortgages as we know them go back to the early 30s. At that point, the home ownership rate was about 45%. The couple of acts that started all this were the Banking Act, which limited interest rates, had Reg Q in it, and it limited the interest that banks could pay on savings accounts to 3% and eliminated the checking account interest, which did exist up until that point.
Bill, are you sharing your slides?
I can't see a slide.
You can't see the slides, okay. All right, I'll go back to the beginning. I'll end the show and start all over again. Can you see him now?
Nope.
All right, we'll try again. Slideshow.
It's share screen at the bottom.
Share screen. Hang on a minute here.
It may be at the top for you.
Okay, share screen. Okay, there it is. Okay, got it. Okay, I will try again here.
You have to select the PowerPoint.
PowerPoint. Slideshow from the beginning.
Woo woo. Good going.
Okay, here we go. You got it?
Yep.
Okay. Okay. As I said, mortgages as we know them go back to the early 30s when the home ownership rate was 45%. The first act that was passed that involved this was the Banking Act, which limited interest rates to 3% for savings and 0 for checking. Right after the Banking Act, following year, the Housing Act came out. The Housing Act authorized the Federal Housing Authority, which authorized the Federal National Mortgage Association, or Fannie Mae. A couple of years after that, Fannie Mae came out with a standardized mortgage criteria. You had to put 20% down. You had to have enough money to 36% of your, no more than 36% of your gross to cover the payment. You had to have a good credit history. You got to do an independent appraisal. And this is where 15 and 20-year amortizing loans first appeared. 30-year loans really didn't take over until the early 50s. Skipping ahead about 20 years, a couple of wars and depression later, home ownership was up to about 60% thanks to a lot of vets buying houses. And in 57, in order to stimulate the economy, the FHA lowered that 20% limit down to 3% for FHA-only loans, which gets us maybe to lesson 1, because 7 years later, the default rate on those loans was 16 times higher than it was before they lowered the down payment requirement. Throughout all of this history, for the next 30 years, the default rate when you put 20% down was within a couple of points of 0.75%. So that's really a good indicator. In 67, Fannie Mae came off the federal budget. In 68, Congress started Freddie Mac, which was basically the same thing, and that never was on the federal budget, but they were both now government-sponsored enterprises. Sponsored, of course, means funding. So now they're GSEs. They were called quasi-government agencies, which has basically no meaning. They were closer to government agencies than they were to private corporations. They had all the benefits of a government agency, but they issued stock. They were listed on the stock exchange. As we got into the 70s, the home ownership rate is about 64, almost 64 and a half, and inflation is starting, or getting higher anyway. In 76, it was 5.8. It peaked in 80 at 13 and a half. And the biggest effect of all this was, well, aside from the savings and the mortgage rates going up in tandem, savings banks had a lot of rate issues. Reg Q, which that 3% that they had been living on for quite a while, just wasn't making it. In the beginning of the 80s, Fannie and Freddie started issuing MBS. MBS stands for mortgage-backed security, which is simply a bond. It's a bond, like all bonds, it's backed by an underlying cash flow, in this case, the mortgage principal and interest. A derivative, while we're at it, is simply a portion of that bond's cash flow, which the owner can whack up any way he wants. As the 80s opened, savings banks just couldn't deal with the way the rates were falling. Or the rates were moving around. Starting in 80 and going into the 90s, it started as a trickle of banks failing. By the time it got to 88 and 89, it was pretty much of a flood. Not all savings banks failed, but most of them did. They were all FDIC, or many of them did anyway. They were all FDIC insured institutions, which means that the Treasury and the taxpayers were on the hook. At that point, the estimates range from 200 to $500 billion. Most of them are around 4 to 500 billion, and that's in 1980 money. The thing to note there is that savings banks did most of the mortgage lending. In 75, Congress had passed the Home Mortgage Disclosure Act, which required lenders to track their applicants by ethnicity. In 88 or 90, 89 or 90, the Boston Fed came out with a report that said minorities were declined 2.8 times more than non-minorities. ACORN, the Alliance for Community Organizations for Reform Now, came out with a similar report, and they had a spread of 1.6 to 3.4 times. At the time, the Boston Fed was questioned by a couple of people, and a couple of years later, the authors of that report revised their numbers downward quite a bit, but these are the numbers that were around at the time. So as the 90s opened, home ownership was around 64%. And right after these studies came out, Congress passed the Federal Housing Enterprises Financial Safety and Soundness Act, which, among other things, directed HUD to set minority lending goals, which they did. The first of the goals was that 30% of the loans that Fannie and Freddie purchased had to be to the low and moderate income group. There was also a goal of underserved areas by specific census tract, also had to be 30%. And that was not another 30%. The same loan could be in both places. Another thing it did was to say that the GSEs could now buy loans, which they had been limited to buying loans that had 20% down payment. Now they can buy loans with 3% down payment. Besides, there was always a dollar limit on how big the loans they could buy were, but now there's the down payment changed. With that, Congress came out with guidance and set up sort of a hierarchy. Congress was going to tell HUD what to do. HUD was going to tell Fannie Mae and Freddie Mac what to do. And at the same time, the institutions, the lending institutions, because Fannie and Freddie cannot do loans directly. They have to buy them from somebody. So the lending institutions were told that Fannie and Freddie were going to modify their guidelines as needed to address the borrowers that were targeted here. But there was a hole in it. The original act defined low and moderate income, that's two groups, not one, low and moderate income groups as percentages of, I believe it was a percentage of the median income involved. What they didn't say is that the people in those areas, in those groups, were the only ones who could put 3% down. Anybody could put 3% down. So if you could put 20% down, you had a decision to make. Do I put 20% down on a smaller house, or can I put 3% down if I can swing the payment on a bigger house? Prices were going up, so it was not an incredibly bad decision to put 3% down if you could swing it, and we'll see what happened there. As time went on, by the time you got to 95, the low and moderate income group was, low and moderate income goal was 42%. And the GSEs are now looking for customers. In order to attract customers, they made the payment on an amortizing loan. You can only make the payment so low, but what they did is they started to buy ARMs. ARMs, by their nature, will have a lower interest rate and lower payment when they start anyway. The other thing they did to attract people is that they, obviously it takes money to close on a mortgage. Fees, attorney's costs, taxes, whatever. They started buying loans that were 105% of the appraisal. That went up, I think, to 110, but I can't be sure of that. So that when Mr. and Mrs. Low Income walked into the house, they were already 5% underwater. So over time, what happened is that the standards gradually deteriorated. No income, no asset. Things came about to be called ninja loans. No income, no job, no asset. Here's your loan. At that point, the volume is moving along quite well. Housing prices are going up, and HUD announced that they were going to, in 99, they announced that they were going to put another $2.4 trillion into this process. The year before, in May of the year before, they announced that they were going to put 1.6 trillion into it. So there was a lot of money floating around here. And that's in addition to the at least $1 trillion that HUD was distributing to local municipalities to do basically the same thing. So there's a lot of money in chasing not so many houses. Since this thing had started, since the act had passed, there were people who said, just based on the economics of it, this isn't going to work. There were a lot of quotes you could find. I select these two because they both basically say the same thing, in that they're both predicting that while the economy is good, everything will be fine. But as soon as the economy runs into trouble, the buyers, the lenders, and Fannie Mae and Freddie Mac are all going to get in trouble, and the government's going to have to pick up the bill. The other thing that's interesting about these two quotes is that they come from two people who are at completely different ends of the political spectrum. They couldn't be more apart, and they probably never agreed on anything else in their lives, but they both said these things. As the 2000s started, nothing happened in terms of those two predictions, but prices kept going up. The volume of mortgages kept going up, and house prices kept going up. Home ownership is now 67, and in the early 2000s, as we all remember, there were two hits to the economy that were pretty close together. The dot-com bubble busted, and unfortunately 9/11 happened. When those two things happened, the Fed did what it always did what it did a couple of months ago. It lowered rates. These happen to be the Fed funds rate, but everything pretty much follows, rates pretty much all follow each other. As you can see, from 2000 to 2001, rates dropped substantially, and they really stayed down there and didn't start going back up again until 2005. In 2003 or 4, 3 and 4, there were House and Senate hearings from the respective Financial Services Committee, excuse me, and not surprising, not a whole lot happened as a result of those hearings. The only thing they're really memorable for is some of the incredible quotations that came out of the mouths of some of our elected representatives about this. But that's a different discussion, or a sideline anyway. By 2004, the home ownership rate had peaked at 69.2. And as I said, in 2005, the rates were rising. As the rates rose, the defaults that had been hidden by the ability when rates were low, either to refinance, wait for your arm to refinance at a lower rate, wait for your arm adjustment to show up and go lower, or to sell the house. You can't do that anymore. The first two aren't available because of the rate change, and the second one became certainly less available because housing prices are going down. In 2006, the rates continue to fall, and there's some miscellaneous numbers that two of them are worthy of note. Fannie Mae and Freddie Mac controlled 3/4 of the market. And further down, you'll see that 37% of those 3% loans were to people who are not in the low and moderate income group. So that, you know, those people made their decision, and that's what happened. In the spring and summer of 2007, Paulson and Bernanke, the chairman of the Fed and the secretary of the Treasury, had some press conferences that acknowledged or made announcements that acknowledged the problem. Paulson said it was largely contained, and Bernanke estimated the loss at somewhere around $50 to $100 billion. Just it may be a second lesson that as soon as Bernanke stopped talking, which was right around right around here is 2007. So that, as you can see, right after that, people just stopped paying their mortgages. I don't think it had anything to do with what they said, but people stopped paying their mortgages. By the end of 2008, everything had collapsed. Fannie and Freddie stock, Fannie Mae stock anyway, was down 90%. Fannie and Freddie are in receivership. And AIG, Washington Mutual, Wachovia, Bear Stearns, Lehman, the list goes on and on. We're all in either some kind of trouble. Lehman failed completely. Most of the others were either bought out or salvaged in the age of TARP, the Toxic Assets Repayment Program. At this point, Congress set up a Financial Crisis Inquiry Commission. They appointed 8 or 10 guys to inquire what happened, make recommendations, etc. They also announced that they were working on new legislation, which eventually became the Wall Street Reform and Consumer Protection Act, or Dodd-Frank. And they brought together people from the Fed, the OCC, and the rest of the alphabet soup that were had supervisory responsibilities to develop a mortgage program that would be stable in the future. The first thing that came out was the Financial Crisis Inquiry Commission's report. It was the first thing out, and it became the accepted history of what happened. That report, it's about a 700-page report. It primarily is about what happened. And it's on the internet, and it is written in English, for those of you who want to look. A couple of things that it said were the GSEs participated in the expansion of mortgages, but they followed rather than led Wall Street. And a prime example of the lack of supervision, which is what they're referring to, is that the Federal Reserve failed to set prudent mortgage lending standards. In conclusion, they said that these two entities contributed to the crisis were not a primary cause because, and you can tell that because their securities essentially maintained their value throughout the crisis. As I said, that became the accepted history. And we can go back and talk about the accuracy of those three statements, but basically they weren't. The next thing that came out was Dodd-Frank. Dodd-Frank is a little bit different. It's a 2,300-page, very wide-ranging document that covers pretty much the entire gamut of financial services in the country. Unfortunately, a lot or almost all of it is written in bureaucrat, so it's a little bit harder to discover. but it did say a couple of things that are close to intelligible. One thing it said in the mortgage section, which isn't that big of the bigger part of the whole report. One thing it said is that it told the creditors that from now on, don't make any residential mortgages unless you have made a good faith determination verified based on verified and documented information that the consumer has a reasonable ability to repay. In English, that's telling the creditors to stop doing what they were told to do and go back to doing what they were doing before the law passed, which is sort of interesting. A couple of paragraphs down, it says, when somebody does default and a creditor initiates a judicial judgment, the consumer may allege a violation by the creditor as a matter of defense. So the guy who defaulted can sue the lender for making the loan in the first place. Beats me. The third part of this was the getting that group together to come up with a standardized stable loan. Incredibly enough, that took that took a couple of years. These two things were out within 6 months. What happened is that the regulators came back the first time with something that was pretty close to what Fannie Mae had said in 1938, 20% down, etc. That didn't fly. That went back and forth a couple of times, and Congress, who controls the money supply, won. And what we got was this: a FICO score of 500, which is really, really horrible. And all the other things you see. And I don't know whether they put this in for laughs, but you had to prove you had a job, which was of course different than it used to be. So that's basically what happened. Now here we are 10 years from all this stuff, trying to figure out what lessons were learned from it. Turns out most of the lessons that were verified by all of this were things that people already knew. For example, a lot of people already knew that there was a relationship between the down payment percentage and the default rate. A lot of people ignored that one. There was also a similar relationship between the credit score or credit history and the default rate. That got ignored too. Those predictions I noted that were only happened to be two of the people that talked about it. Those predictions could have been made just by knowing those first two things. Another thing that was reinforced, but possibly ignored, was that when an unlimited amount of money chases a limited amount of product, you get a bubble. Prices go up, and they go up a lot, which is exactly what happened. Another lesson that was reinforced is that winners write history. The FCIC Commission and the FCIC report were directly a product of Congress. As I said, they became the standard history or the accepted history of all this. And what they did, as you could see from those quotes I showed you, they completely ignored Congress, they completely ignored HUD, and they pretty much tried to absolve the GSEs of any responsibility. They pointed a lot of fingers, none of them at Congress or HUD. The lesson that was learned was that after almost 12 years of ninja mortgages, giving anybody who wanted a mortgage the ability to own a house, the rate got to 69.2. A lesson there, possibly, is that 30% of the households in the country may not want a house for whatever reason they have. They don't want the aggravation, they don't want the loan, they don't want whatever. Finally, as we saw, Fannie and Freddie controlled 3/4 of the market. If you add what the 5% or so that the FHA had, you had about 80%. So you had government control of the residential mortgage industry. Another word for government control of the industry is that it was nationalized. They took this, the people who were running this thing, took this nationalized industry and directed it towards achieving a specific social goal, which, as we saw, is probably unattainable. As a result, they pretty much, well, they didn't wreck the economy, but they negatively impacted the economy. And the people who took it in the neck most were the low and moderate, as usual, with the low and moderate income group. That group, as a percentage, lost their down payment, they lost their equity, they lost any positive history they could have established while all this was going on. As a numerical measure, the home ownership rate, which was 64% before this started, went from 64 to 69 and bottomed out at 63 in 2016. I think we can all make a good guess as who was most impacted by that 11%, which income groups were most impacted by that 11% swing, and 1% negative net. The lesson here is that this particular experiment in using a government monopoly to achieve a social goal was a complete failure, and it hurt the very people it was trying to help. I'm done. Lou?
Thank you very much, Bill. Would you turn off your screen share, please? And
Borrowers were at fault, or the real estate industry. They really look at this as Congress, the regulators, and then there's a significant portion of folks who think everybody was at fault. Let's go down to the second question. This is interesting. So the winner appears to be not at all. People didn't feel that they were personally affected by this. 12% said, yeah, to a great extent. So this is really just for the discussion. So what we're going to do now is stop the sharing and put you into breakouts. So again, there's no facilitator in the breakouts. We encourage everyone to participate. Lou and I will be going in and out of the different rooms, so you might see us pop up just to check in with you to see that everything is going okay. If you have any questions, you can ask us a question when we pop in. So over to you, Ian, to get us into our breakouts.
I'm going to make 8 rooms. That should be 6 people a room. Or do you want just 7?
Oh no, that's fine. Whatever you think is a good mix.
That's 6 participants a room.
I'm going to stop sharing. Who's our first speaker?
Ian, would you put me in the queue at some point?
Yeah, I will do. I don't see anyone.
We have Dave Dunlap in line.
Okay, ask him to speak then.
Okay. I'll tell you what.
I
you
got
want-
them now. Okay, thank you.
Got him? Okay. So Dave, when you are ready, unmute.
Okay, we got it. Mine's probably to some extent a little bit of a controversial question, but I'd like to know where is the current administration presently in Congress on the data that you described regarding down payments and whether you have to have a job and those criteria for loans. Where is the current administration? And to what extent did the political perspective create the problem that we had, 10, 20 years ago? Was that primarily a Republican led, primarily a Democrat led? Was it equally, can the blame be spread equally? I'd like to hear the speakers comment on that. Thank you.
Over to you, Bill.
Well, the current situation is pretty much what I showed you in terms of the loan to value requirement or criteria. And if you watched a recent golf tournament, you would have seen that you have the ability now to do not much more than click a button in order to get a loan. So that's what the law is and the criteria is now. In terms of the current situation, I'm not entirely sure of what the actual policy is. The practicality of it is that Freddie and Fannie are in receivership. It's possibly possibly a political policy that they're just not being funded. They cannot do mortgages to the extent they did because they don't have the money they did. I assume that stuff that you saw on that golf tournament, who is it, Rocket Mortgage, and there's an admiral on television trying to get vets to do basically ninja loans. I'm assuming that all of that stuff goes through FHA, which doesn't have that much money either. So there is some limit to what's the practicality of what's being done. Because I'm sure that the people that are doing it are not keeping the loans. That's just an untenable situation, especially for a non-bank. That's absurd. In terms of
Catherine?
I'm sorry.
Next
The
question,
second question we had in
Catherine?
terms of the political.
Yes, I'm going to yield my time to Jim Yukokis.
I think you have to contemplate what the incentive structure was in this whole thing. Why were the bankers actually making these loans when in many cases it was pretty obvious they were not going to be able to repay them? A couple of things were involved there. One is because housing prices had historically continued to go up, it was felt that it was a pretty safe venture, and that if anything went wrong with the repayment circumstance, that you would always be able to take the asset back and realize the money that you had loaned. As soon as that became questionable, the whole thing began to fall apart. The second thing is that there was, in fact, an implied insurance behind all this with Fannie Mae and Freddie Mac, and that was a second line of protection. On the other hand, the bankers who had been allowed, not required, but allowed to engage in the mortgage lending that they did, had the incentive that they understood once we got into packaging mortgages and selling them off as bonds. The banks were not going to hold these at all. The banks made their money by originating the loans. That was where they took their money. And then the loans themselves were sold off to or combined in bundles that became derivatives of various sorts. And the banks were basically off and free. The idea that some kind of social policy of trying to expand home ownership in the United States drove the financial system into decline is really not quite right. The idea that that's what the government wanted is correct, but they were not requiring the banks to go ahead and make what were obviously going to be very questionable and in some cases hopeless loans. The banks began to realize that they did not have to verify anything in the way of the income and capacity to repay those loans. They did not have to worry about the kind of leverage that was going on for the individuals and for the various financial institutions in between.
Hey,
And
Jim,
as a consequence, they just kept making their money from the origination of loans without paying much attention to the prospect of them being repaid.
Thank you.
hey, Ian, I see, did you miss Peter?
No, I've got Bud Weber up next.
Well, could I respond to that?
Yeah, go ahead.
I think a couple of the things you just mentioned are self-contradictory. For one, in terms of the incentive for the banks to do the loans because they were making money on them, the banks did not keep the loans. Commercial banks basically do not want to do 30-year fixed rate or adjustable rate loans for that matter. They just didn't want to do it, and they did not keep the liability. That went to Fannie Mae and Freddie Mac. Certainly, you are correct in that Freddie Mae and Freddie Mac had an implied guarantee by the government, but that was secondary. The third thing you mentioned is that the banks were not required to do these loans and decided to do them all and send them to Freddie and Fannie on their own, which is absolutely incorrect. the bank's position in this was basically between the rock and the hard place. When Mr. and Mrs. Low Income came in and said they wanted to do the loan, bad as it was, if the bank said no, Mr. and Mrs. Low Income go out and they find a newspaper, a community organizer, a politician, or somebody, and complain that the bank didn't do the loan. The bank would be lucky enough not to be sued. On the other hand, if they turned down the loan, that would have gone into the pile of loan turndowns. And when the regulators came in and said, how come you didn't do this loan? Saying that, well, I don't think we should have done this as a prudent thing. That was the wrong answer. They would have been criticized for that too. What they did have to do was meet goals, both for Freddie Mac and Fannie Mae and themselves, to do those loans. They just basically had no option. In terms of the social policy, I think if you really look at this and see what was done and see some of the comments that were made about how it was run, it was definitely the social policy to achieve that low income goal. Whether or not it's a good policy or not is beside the point. That was the policy and it didn't work.
Okay. Bud?
Thank you. Good presentation. Before I get started, I want to mention a plug for my own club. On August 13th, the Freethinkers Club next presentation at 1 o'clock, I will be presenting how to meld Republican and Democratic principles in overhauling our healthcare system. As far as some questions and comments, I think one of the problems was that you didn't mention much was rating agencies. The rating agencies rated these bonds AAA, and they were full of junk, and they should have known better. Part of the problem is that our rating agencies are paid by the companies that they rate, and so they have an incentive to give a good report. Our regulators didn't seem to know that the quality of these loans were bad. Greenspan famously didn't believe when he was told the percentage of the loans that were poor quality. And I think the bank's underwriting problem was caused by the fact that they weren't required by regulators to keep a certain percentage of the loans. So that they were just a pass-through. Nobody was underwriting the loans to see whether these people could, in fact, pay back the loans that they were taking.
You are correct about the pass-through part of that, doing them one at a time. As a matter of fact, that third issue I spoke about, where the regulators were getting together to do create a stable mortgage. One of their iterations of that did contain that or a section that suggested that the banks have to retain a certain percentage of those loans. That was taken out in the discussions with Congress. The first thing you mentioned was about the rating agencies, and you are again correct. But if you look at the whole situation, there were, as I said, there were trillions of dollars, millions of mortgages, regulators, rating agencies, credit agencies. There were a lot of people involved in this. To say that everybody did everything right is just a foolish statement. However, the bottom line to all this is that as a result of the criteria or lack of it, a lot of people got put in a position a financial position where, for one reason or another, they should never have been placed. And as a result, they didn't pay their mortgage, and they didn't stop paying their mortgage because the bonds were overrated. The bonds may have been overrated because there was a possibility that they would not repay them, but that's not what made them stop paying the mortgage. They didn't pay the mortgage because they shouldn't have been there in the first place.
Peter?
Yeah, two things. First, I want to start with my own history. The first time I got a loan for a house when I was a young man, when I was filling out the loan paper, the fellow who was doing it with me told me when it came to putting down how much money I was making, well, put down whatever you want. That's not important. Just make sure it's over. And he gave me an over criteria. Fortunately, I kept making my income improved thereafter, so it didn't become a problem. But I saw that as being one aspect of the problem. The second is, Bill, first off, thank you very much for your presentation. You've improved it, I think, since the last time you gave it. And I thought it was very, very good. The one issue is, yes, the banks were in between a rock and a hard place, as were, people ultimately when they thought they were going to be able to flip their house and then they couldn't anymore, and things got bad for them. So people don't want to lose money. So what the banks did was they derivatized, and then the real problem in terms of lesson learned is we probably would like more transparency. If we're going to create derivatives, if we're going to create investment vehicles, we need to have more required transparency of what the risk is associated with the investment vehicle. So if you're going to sell it, there has to be more transparency about what the risk is associated with it. But I just want to make one more generic comment, and that is about the whole notion of politicizing political bias, or not political bias, bigotry. That's a general problem now. And what society tends to do is it overcompensates. You recognize that bigotry does exist. We're seeing it now with some of the police actions. But then, for instance, in the police case, you generalize it to all police, which is absolute nonsense. Clearly, there are individuals who are bigoted, and whether they're in the police or they're in a banking industry, they may, act in a bigoted way. And the question is, do we respond as a society to these things in a rational way, or do we go off the deep end in responding to bigotry? And I think that's the basic problem that we have to deal with. How do we respond rationally to reduce bigotry and to identify it, but not respond in a ham-handed way as a society, the consequence of which can be worse than the problem we're trying to solve.
Okay, Peter, you're at about 2 minutes. But
I'm done.
Bill, did you want to?
I was going to ask Salute him.
Only to say that transparency is fine, and would certainly have been a good thing. But again, the lack of transparency had nothing to do with what ultimately happened. The people who didn't get transparency in terms of investing in any derivative or mortgage-backed security were certainly not in the low and moderate income group. That would have affected a lot more sophisticated investors than what we're talking about here. The other thing about the rational way of responding, I completely agree with, and that the thing that was missing here is helping people, fine. Let's do it rational way, which to me means do it in such a way that A, it has a really good chance of working, and B, has a really low chance of wrecking the economy.
Okay, Lou, do you want to ask your question?
Yeah, I just had two comments. There's a long-standing principle in management, whether it's industrial management or military command structures, that says basically the correlate of authority is responsibility. And as soon as you set up a structure where there is no down risk, where there is no responsibility for the results of your actions, as the banks were able to say, we can write any loan we want, but we don't have to worry about it because somebody else buys it from us. Things like Rocket Prime, the Rocket lenders that basically are not responsible for the loan, they just pass it on. I think as soon as you set up that kind of a structure, you're setting up a system that's going to do damage. The other comment is, talking about the social issue, we have a tendency to try and do a quick fix. We want something fixed tomorrow. And long-standing social problems do not get fixed tomorrow. They take years to fix. And the result of setting up a quick fix program very often is a disaster. And I think that's what you're alluding to, Bill. That's it.
Certainly is. I agree. I agree with your second comment. The first one about the responsibility of the banks, I would dispute. I think the banks did what they had to do because of where they were and the position they were in.
But the structure was set up to allow them, designed to allow them to do this without being long-term responsible for what they did.
That's certainly the way the structure was, but that doesn't mean that they had to do it. And that goes back to who set up the structure.
Yep.
So John Blackwell, looks like you're next.
Okay, thank you. Yes, Bill, that was a great presentation. I would have two comments. One is that in the last year of the Clinton administration, HUD put up on its website a proud announcement that the Clinton administration had fined banks for failure to lend to minorities and other underprivileged people 2.5 times as much as all previous presidents put together.
Yes, they did.
That remained up throughout the Bush administration. It was taken down the day after Obama was inaugurated. The other thing I would point out is that during the Obama administration, the Justice Department put a lot of effort into trying to find some major bankers they could charge with criminal conduct. The only bank that they were able to and willing to send bank officers to jail was a small Chinese American bank in New York.
Wow. You're absolutely right. In the age of TARP, there was a thing called, I forget the exact name of it, but basically it was the TARP Investigation Committee. And based on their findings, they managed to lock up, excuse me, about 150 people, most of which were small bank officers who were just guilty of fraud. There is a difference between what happened in some of the banks where they made bad investment decisions and overdid their percentage of mortgage-backed securities or derivatives or whatever they held. You're supposed to be diversified in any, whether it's a personal thing or a company making investments. You're supposed to be diversified. People who committed fraud were locked up, but as you point out, there weren't any big ones. Interestingly enough, the European Union locked up almost as many people as the United States Task Force did, and incredibly, most of those people were from Iceland, who were manipulating the value of the bonds.
Wow.
So basically,
John
right.
Hunter, you're next.
Yes, very good talk. You gave a statistic in our group that about the 20% down thing. You know what the percentage was of the failure rate on that was. In my own personal life, I've loaned money out for land and whatnot, and I always went by the 20% rule. and that worked really well for me. And only one time I loaned money on some forest land in Oregon, 200 acres, and for $45,000. And that time I had to actually put some heat on the guy to pay me back. I wasn't worried about it because it was worth a lot more than what he owed me, but he came across with the money. Other times, like on a farm in California, I went. I let them pay just interest only because I knew they were having hard times and all that. But I've never had a problem with it at the 20% level. So what was that statistic?
The statistic is over time, and at least from the early 60s and probably before. I haven't seen anything before that, but from the early 60s until now, probably, if you put 20% down, your chances of the default are about 0.75%, or one person out of 150. And to the banks or any business, that's just breakage. That's a cost of doing business. You're not going to get everything right all the time, but if that's the requirement, if 20% is the requirement, as you point out, you're pretty safe. It stayed that way for a long time. Still is that way.
Okay, Carol, it looks like you're next.
Susan.
Thank you for sharing your expertise with us, Bill. My experience is similar to John Hunter's in that we have sold a number of houses over the years and offered a mortgage if the people met our requirement. And our requirement was the same that we applied to ourselves, that if we didn't have 20% to put down, we needed to save a little more before we bought the house. But I'm interested in your response to an experience I had in 2007. We were selling a house that belonged to my stepfather, and the house was paid off. So typically we would offer a mortgage to the buyer, but they did not have the 20% down. Well, they went to the bank, they got a mortgage for the house for the entire amount of the house, plus $4,000 cash in their pocket. I've never heard of that before or since. And I'm interested in your response to it.
That was part of one of the criteria. Doesn't sound like the right words, but that's one of the things you could do. The Fannie Mae and Freddie Mac were buying loans that were well in excess of the appraised amount of the property. Theoretically, it was to cover closing costs, but if somebody found a cheaper attorney or wasn't paying taxes or something, that money went in their pocket. That's just what happened, and that's part of what was going on with the rules that were set up. As Lou mentioned, the structure of the whole thing.
Susan Seagull, I missed you.
Just as a PS to that, this is a house that I get a chance to check on once or so a year, and I'm always curious to see, what its fate was. And they are taking good care of the house. It is not, left to go to ruin or anything like that. So in this case, I guess there was a happy ending to it.
Still pretty incredible. Ralph, you're next.
No, I said Susan.
Oh, Susan.
It's not Sue, it's Dave. I snuck in or whatever. She's got top billing.
It's an interesting
The things that I wanted to say, I mean, we had that form to fill out, who's the main fault. Quite honestly, government right now is attempting to, I don't know, whatever the politically correct terms are. They're trying to set everything fair. The definition of fair, it's simply unable to define it. But our personal experience here in the villages, the average age here is 70. You can go out, first of all, they can't deny you a mortgage because of your age. So you can go out there and get a 30-year mortgage. I don't know, the chances of any of us, paying off a 30-year mortgage if you're 70-something is probably pretty close to zero. But they're still gonna give you the mortgage, which in itself is kind of weird. And yes, we have a mortgage on this property. I went over to the bank. I don't know, something to the effect that I needed to show more income. So they directly told me what to do. You call up your brokerage and get them to fill out a letter. They even had the form letter there that they're going to agree to send you $1,000 a week out of your account, and boom, you qualify. And the guy told me up front, he says, 2 days after you get the mortgage, you call us up and you can just cancel it. And I go, okay, that makes sense. I mean, these people know what's going on. I'm no whiz at beating the system, but it's not any kind of secret. And, it basically shouldn't be allowed or shouldn't exist or whatever my excuse is for it. But this is all, government in action. They're supposed to be the experts. I'm not. But, it's pretty easy to beat the system if you're looking to beat it.
Wow.
Well, one of the problems with that is that certainly based on the laws that they exist, no matter how old you are, they can't say you're too old to have a 30-year mortgage. That's just not going to happen anywhere. In terms of what you're talking about with the getting a letter from somebody that says you've increased your minimum IRA withdrawal. What you have to look at, that's something that's going to happen, because what we're talking about here in terms of underwriting a loan is a point in time. As of this point, a reputable organization is going to send you another $1,000 out of your account. So as an underwriter, you say, okay, this is a reputable organization. It's it's not the bookie down the block that's lending you another $1,000 a month. This is somebody that is going to give you your money, and that's what they have to go by. To say I don't believe you, that's going to wind up in court too. It goes back to the issue that it's a point in time. Any mortgage decision is made now. What happens tomorrow? The lender certainly doesn't know. You're kind of stuck. One other point I'd like to make that's been talked about the 20% thing is that there's in any situation, renting a car, renting something, people take care of things that they own better than they do things that they don't own. That's just sort of human nature to the thing. If you rent a car, you might use it as a cross-country vehicle in places where you wouldn't do that with your own car. So it all goes back to the more you put down on the loan, the less likely you are to default.
Wow. Okay,
Carol next.
What's that?
Who's next, Ian?
Carol.
Ian, can you say that again?
I thought I was next because they asked.
Who's done first? This one second.
Are you skipping over Ralph?
I don't know what's happening. Some people were unmuted already. Penny, you go ahead then.
Okay, I'll go quickly. This is a little bit about the future, and I wondered if we'd learned lessons on this, because I know quite a lot of millennials. That's the 23 to 38, 25 to 35-year-old group. And they're not interested in buying a home now for many reasons. And I just looked up some statistics, and 1 in 3 millennials own a home at the end of 2018. And that's a lot less, that's 8 to 9% less than our previous generations at that age group. And 2/3 of these millennials regret purchasing their home because they say that the costs are too high to run it, that they didn't realize it. But one of the big reasons is the fact that their jobs move them around. They're out searching for work in different parts of the country, and they've got to sell their home. And I'm just wondering now with this, the after effects of the pandemic, and they're saying people are going to be working from home, how is this going to change the outlook for the mortgage industry? Will people want to rent more or not? So that was, I was wondering, Bill, what you thought about that.
Well, certainly demographics change everything, it's somewhat akin to the statistics on marriage. People are waiting longer to get married. If they wait longer to get married, you don't need a house. So I don't know what the correlation is between those things. And certainly, as you brought up, working from home is going to be part of it. And I really never considered that a whole lot, other than if you're going to be working from home and be at home more often, I want to be in the nicest place I can be in.
But I'd like to say that I do disagree with your thing where if you're not going to get married, why do you need a house? I mean, I got divorced way before I bought my first property, and I've owned 4 properties since getting divorced and have no intention of getting married again, but I happen to want a home. So
certainly, I made a general statement, and
well, I happen to know a lot of single people who want a house. Yeah. Okay, but it'll be interesting going forward. I think it's there's going to be a lot of rental properties in the office buildings in New York City that are going to be coming up soon.
That is certainly going to happen.
Yeah.
Okay, maybe we can switch to Carol. Carol?
I think Carol's already gone, Ian.
She's gone, next. Then we have Ralph McNeil.
Yeah, can you hear me?
Yes, I can.
Okay, there's an interesting statistic associated with depressions and the Great Recession of 2008. And that is, in the history of the United States, there's been about a half dozen times when the U.S. federal government has run a surplus rather than a deficit. The last surplus was during the Clinton administration. And lo and behold, it was followed by the Great Recession. Yeah, it was 8 years later. I'm kind of curious, and one of the reasons or something that might be behind that is when the federal government is in deficit, the private industry, the economy is in a surplus. Okay, and when the federal government is basically running a surplus, it takes money out of the economy, which basically creates a deficit, economically in the economy. And I was wondering if that played, how much that may have influenced, the great, getting to the Great Recession. Did it impact the mortgage industry, or was it just more of a factor on the economy, just overall in general?
Well, certainly the government's ability to put boatloads of money into this process in 97 and 98, they put at least $5 trillion into the housing industry. If they didn't have the money, which they probably didn't anyway, but if they didn't have any money, they couldn't have done that, or would have just been a dopier thing to do. But they spent the money they had, and they spent more than they had, and certainly, as I mentioned, that pushed prices up. It created the bubble. And the more prices went up, the more money they had to throw into it. So the answer to your question is, yeah, that contributed to it.
We got a first time here, and that's Alexa Nuno.
Alexa, you're muted. You need to unmute.
Okay, forget. Excellent talk, really enjoyed it. Now, since we're getting ready to wrap up, if you could wave the magic wand and make reforms to Dodd-Frank, what would be your top 3?
Reforms to Dodd-Frank. I'm not sure of that. I know that just as a general statement, Dodd-Frank is a 2,300 page document. In my personal opinion about 2,300 page laws is probably nobody read them, and B, there's more than likely stuff in there that shouldn't be. If you look at Dodd-Frank, forgetting what it thought, the wide-ranging effects it had on the financial industry, there's stuff in there about diamond mining, about the coal industry, about oil exploration, and getting back to my major point about 2,300-page reports, there's stuff in there that people just added for no reason other than they could in that current environment. So my general statement is that regardless of political feelings, it ought to be looked at to see what actually is in there, because I'm not sure. I do know that there was one thing in there that I don't know how much it cost somebody, but they exempted the manufactured home industry, and it pretty much wrecked that industry. If you Google Dodd-Frank and the manufactured home industry, you'll find a whole series of articles by people in that industry complaining about it, and that was resolved. But I don't know if that's the only one. So I think it's well worth looking at for no other reason than it's too big.
Okay, and who's next?
Well, I'd like to ask a question. I'll make a comment. I noticed in the opinion poll, most people felt it had absolutely no impact on them personally. Well, I think it's impacting me every day. I get incredibly low interest rates on my savings, on my bonds, because you've had a tremendous amount of money flowing into the market to solve this problem. Interest rates are at an all-time low, which is a transfer of wealth from the savers to the government. So yes, it impacts me every day.
Bill, you were a banker. What's your thoughts?
Is he referring to what's happening now or what happened then?
I mean, since the crash we've had, the government has put in billions of dollars of liquid money into the market and has depressed interest rates.
Oh, absolutely.
And that represents an incredible loss of income for me as a retiree ever since the crisis happened. On the other hand, my stock prices have gone up, but if you're living off interest, it's really hurt me.
That is an economic truth, no doubt.
And a timely one, since we're looking at somewhere between 1 and 3 trillion more in the way of funny money to be injected with no basis for it into the economy. Who's next? John, did you?
John Blackwell's got to repeat, I think.
Yeah, John, I think it's you. Can you unmute?
Okay. Actually, somebody else said more or less what I was going to say when I did it, so I'll pass.
Okay, thank you.
Peter, I think you get the last question then.
I sneak one in at the end.
Oh, all right.
So look after Peter.
Peter, are you on? Okay, Peter's muted and his picture is off. So why don't you go ahead, Lou?
Somebody was asking about what we should change in the structure. And I think there's a fundamental change that has to be made. And that is that we need to go back to requiring responsibility. Whether it means that whoever issues a mortgage has to keep 10% of it, or that the government structure says, while we aim this, while we would like you to do this, here are the limits on how far you can go in doing it. I think we have to go back to saying there's a responsibility in an industry or a government that you have to be careful of what you do and accept the fact that if you do something with poor judgment, you individually or as a company will bear the responsibility for it.
Lou, I got it at about 11:29. Why don't you close this out?
Yeah, I'd just like to read a quote that bears on what Lou just said. This was from the hearings in 2003 and 4. I do not want the same kind of focus on safety and soundness as we have in the Office of the Comptroller of the Currency and the Office of Thrift Supervision. I want to roll the dice a bit more on this situation towards subsidized housing. That was in the House hearings, and goes to. I popped that up real quick based on what Lou just said about responsibility. That was made by a representative in Congress at the time, testifying at the hearings about how he felt that should work. He did not want supervision. The Office of Thrift Supervision and the other one he talked about at least had some idea of what they were doing. Freddie and Fannie were supervised by a small department in HUD, which is mind-boggling. But that guy was actually arguing that that level of supervision should continue. Plus, the last part of that is he rolled the dice on this process. He rolled the dice on the economy of the United States, and he walked away as a hero. That goes back to the second thing I mentioned, or second or third thing I mentioned about winners writing history. It is, and that's the thing that bothers me most about all this. The people.
Are you being frank with us?
Excuse me?
Oh,
Frank with us?
no, he's being Don with us.
Oh.
Yeah, I'm doing both of those things. And both of those people walked away as heroes, which, as I said, bothers the hell out of me. And they actually tried to write the corrective measures to all this, it makes me nuts. It really does.
Lou?
I think, are we done?
Closing out.
All right, thank you all very much. Thank you, Bill, Frank, Ian.
It was a pleasure.
Our next online meeting scheduled Monday, August 17th, and you'll get an invitation to that sometime next week, the information. Ian Walmsley is going to present. Ian, it's going to be your turn to stand in the barrel there. Geopolitical challenges facing the USA today. And hopefully you can keep it to under 2 hours. That's quite a lot. If you have any comments or questions,